Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Omega Healthcare stock by analyzing their financial statements and dissecting their financial ratios so we can determine if to buy or sell. Omega Healthcare is a triple net REIT that funds and operates skilled nursing and senior living facilities. Triple net is a lease agreement where the tenant pays all the expenses of the property, including real estate taxes, building insurance, and maintenance. Triple net leases provide a secure, steady source of revenue as opposed to traditional leases. Cash flow is more dependable with OHI since the expenses are the operator's responsibility, and the company only takes on quality tenants that provide a 3 to 6 month security deposit. The company is headquartered in Hunt Valley, Maryland, and was founded in '92. It started trading in '92 and can be found on the New York Stock Exchange, London Stock Exchange, and Deutsche Börse. Its portfolio consists of 950 healthcare facilities in 42 states, as well as in the UK. The state with the most facilities is Florida, which makes up 14% of its portfolio. That makes sense since there are a lot of retirees in Florida. Its specialty is in skilled nursing facilities, or SNFs. That makes up 78% of its portfolio. Nursing homes are where people usually go when they require high levels of assistance with non-medical, everyday living tasks. Skilled nursing facilities is where people require medical care in cases such as recovering from a stroke. Skilled care is nursing and therapy care that can only be safely and effectively performed by professionals. Skilled professionals are required in order to treat, manage, and observe a person's condition. As we know, COVID is more dangerous for the elderly than the youth. This company has implemented new and updated protocols to limit the spread of coronavirus. The contagion rate at SNFs has declined 95% since its peak. The occupancy rate fell 11% in 2020, but it is up 3% in 2021. Expenses are up $45 a day per patient. In 2020 and the first 4 months of this year, the company collected over 99% of rent and mortgage payments. That is really impressive, given landlords are having difficulty getting people to pay their rent. Skilled nursing facilities are primarily funded through Medicare and Medicaid, which is the main reason this company has done so well to maintain cash flow during this difficult time. The yield on SNFs are over 9%, which is much more than other healthcare assets, and that's why this company pays such a high dividend. The nice thing about investing in REITs is you get exposure to real estate without having to actually physically own or manage the asset. Although you are taxed at your ordinary income tax rate for REIT dividends, ordinary taxes are between 10% and 37%, depending on your income. Dividends on regular stocks like Apple are taxed at the long-term capital gains rate, which is between 0% and 20%, depending on your income. Just something to consider when investing in a REIT. Let's get started with the model. This is a mid-cap company, 8.8 billion market cap. They're trading at $37 a share, and they have 235 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they do have positive and growing free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty steady year to year. It did drop in 2020, but it came back up a bit in the trailing 12 months. Revenue is a sales for the company, and that's really steady, around $900 million a year. This is their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Their cost of revenue is really low because they just have to collect rent and lease payments. They don't have to buy materials to make products or hire a sales force, so their cost of revenue is fairly low. Revenue minus cost of revenue gives you your gross profit. Then below that is operating expenses, and that's mainly depreciation. Gross profit minus operating expenses gives you your operating income, and that's pretty steady. It did drop a little from 2018 from 530 million to 474 million. They do have a lot of interest on their debt. They paid $227 million of interest in the trailing 12 months. And the bottom line of the income statement is their net income, which is positive every year. So their income statement looks pretty good. But when you look at a REIT, the income statement is not a good indicator of how the company's doing because their depreciation expenses are so high, it drags down their net income, and depreciation is a non-cash item, so it doesn't affect cash flow. So the statement of cash flows will give us a better sense of how the company's doing. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generated the most operating cash flow in the trailing 12 months. So even during COVID, their cash flow is still really strong, mainly because they receive most of their money from Medicare and Medicaid payments. So it's kind of like a guaranteed source of revenue. And they don't have any capital expenditures, so their operating cash flow is equal to their free cash flow. And most of a REIT's free cash flow is used to pay dividends. It looks like they're rolling their debt each year, so they issue a similar amount of debt as they pay down. But they do have a lot of debt on their balance sheet. They also add capital stock each year, $75 million in 2018, then $400 million, then $152 million. So every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable, so it dilutes the current shareholders. Their latest financials are as of 3/31, but just recently they announced they were going to sell $1 billion of common stock. I know some shareholders aren't happy with this, because that means their shares get diluted. But if you think about it, just pretend you own the entire company. If you issue $1 billion of stock, sure, the stock does go down, but you have $1 billion of cash. It's kind of like a wash. So if you think about it, if you own the entire business, that $1 billion of cash can be used to grow the business, and maybe in the future, if you grow the business a lot, you can buy back stock. This is the equity section of the company's balance sheet, so this gives you a nice little snapshot on how profitable the company is since it started. So it did raise $6 billion of capital stock, and it lost $2.3 billion. But this is pretty common with REITs. Most REITs have negative retained earnings, because retained earnings is a sum of all your prior net incomes minus the dividends you paid out. And remember, net income is really low because of depreciation charges. So you end up paying out more in dividends than your net income, which doesn't seem to make sense, but it will equal out over time. But especially in the beginning, you take these large depreciation expenses, so it can really skew the numbers. So I wouldn't worry too much about the negative retained earnings. They raised over $6 billion of capital stock. If the negative number in retained earnings got close to the positive number in additional paid-in capital, that could be a sign of a company going to file bankruptcy. But that's not the case with this company. There's plenty of room. Let's look at the capital structure. $4 billion of equity, $5.5 billion of debt. They're 42% equity, 58% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 7.5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $15 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13 billion. We divide that by 235 million shares. And we get a calculated stock price of $56. They're trading at $37, so they're trading at a 34% discount. It's a strong buy according to the model. Simply Wall Street is much higher than me. They're at $82 a share. They're saying the stock is 54% undervalued. 7 analysts priced this stock and the average price target was $40. This is where the stock has been trading since 1992. So you can see it got real low in 2001, 2, and 3, around $3 a share. And its peak was right before coronavirus. And then it came down a lot during the COVID crash. It has come up quite a bit since then. This is the stock price the last 12 months. You can see it got a really big boost at this point. That's when the vaccines were rolled out, and a lot of the people at its facilities received the COVID vaccine. So the stock has been pretty steady the past 6-7 months. They raise their dividend pretty much every year. They're up to 67 cents a share. Their dividend is over 7%, and they pay out 85% of their free cash flow. I wouldn't look at the dividend payout ratio because it really doesn't make sense for a REIT because they have so much in depreciation, it drags down their net income so much, so it looks like they're paying out 300% of their profits. This is from one of the company's reports, 17 consecutive yearly dividend increases. Imagine if you're still holding when you bought the stock at $3 in 2001, your dividend yield will be close to 100%. And their industry pays a 3% dividend. They're much higher than their industry, and analysts are forecasting their dividend to grow to 7.4% in the next 3 years. And their beta is pretty close to 1, so the stock moves with the market. The stock has only gone up 18%, but if you add the dividend, they're pretty close to the S&P 500. And the 52-week low was 28, the high was 39. And the stock is trading above its 50-day and 200-day moving average. You can see the 50-day moving average and 200-day moving average are pretty close, so the stock has been really steady for a while. About 2 million shares are traded each day on this stock. Almost all the shares outstanding are on float. 72% are held by institutions. It has a pretty high short percentage. Over 6% of the shares on float are shorted. In the past year and 3 years, the stock has done pretty similar to its industry and the market. In the past 5 years, it's done pretty similar to its industry, but much worse than the market. Analysts are forecasting their industry to grow more than this company, both in earnings and in revenue. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $36,000 today. That's a 14% annual return. The biggest shareholders are the big funds. Vanguard and BlackRock own over $1 billion of this company's stock, then State Street, Invesco, and BNY Mellon. Let's look at their financial ratios. Their PE is a bit worse than the average. They're at 38. Their price to sales is exactly at average at 9.6. And they do have a good balance sheet. Their price to book is 2.2, much better than the market median and average. Their return on invested capital is kind of low at 5%. They can cover their interest payments 2.1 times. Their ROE is about 6%. That's lower than a market median. They do have a high current ratio. They can easily cover their current liabilities with their current assets. And their current assets are mostly receivables of $1.1 billion. Receivables is when you extend credit. When someone buys something from you, but you don't collect the cash, you collect it in the future. So this can be deceiving. This number is from Yahoo Finance. Most of their receivables is in mortgage notes. A mortgage note is not a typical receivable. A mortgage note is money owed to you. Omega sold one of its facilities to someone, and Omega is financing the sale. So the borrower pays a mortgage payment to Omega. So $885 million is owed to them, but in future mortgage payments. When I initially saw accounts receivable of $1.1 billion, I thought it was back rent, like people owed rent and lease payments from the past. So their receivables are just future mortgage payments that the borrower just needs to pay. So it's not as bad as I thought. And they're well capitalized. They had over $700 million of free cash flow in the trailing 12 months, over $800 million of working capital, and they pay out $600 million in dividend payments. So they have over $900 million of excess funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 6 other companies in the same industry as OHI, and if OHI has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. When you look at a REIT, you should look at the price of the stock over funds from operations per share. That's a much better stat than PE ratio when looking at a REIT. Funds from operations is net income plus depreciation and amortization minus the gain on sale of real estate. So it just adds back depreciation, which drags down your net income. That's why the PE ratio isn't good, because PE ratio is market cap over net income. Their price over funds from operations per share is a little worse than average. They're at 16, average is 14.5. The lower the better. Their price multiples are worse than average. They have a high current ratio, but it's below average. They're a little lower in ROE, a little worse in debt. And they're a decent sized company, the third biggest on this list at close to $9 billion market cap. And they pay a really nice dividend, over 7%, higher than anyone else. So to summarize, I have them trading at a 34% discount, but this company is in a great space because our population is getting older. It's getting older as a percent of the total population, because as people age, they're going to need more skilled nursing facilities. Plus, there's guaranteed income coming in from Medicare and Medicaid. That's why this company pays such a nice dividend. So cash flow will always be strong and healthy. So if you're a dividend investor looking for a nice dividend payment, this is a great stock to buy. It's good to hold long term, and if it keeps going up over time, your dividend yield will keep increasing over time. I rank their free cash flow as 8 out of 10, their revenue 7 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.